Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another live stream, something I'm going to try doing every Tuesdays and Thursdays, 3 p.m. Eastern, give you kind of a market update in a new office here. Obviously, I haven't gotten the sound quite working yet just because if you're hearing the echo out there, I'm going to put up some more soundproofing. So hopefully we can get rid of a lot of that echo here in the future. But great to be back. Really excited about this new office and the new live streams twice a week, the Tuesdays and Thursdays, kind of market updates there. Today we're going to be talking about the 13 Fs that are now out by institutional managers and hedge funds. These are the big money managers that are required every quarter to release and report their positions in stocks, that as well as any insiders and so forth, with more than 10% of the company of the shares outstanding. So very important stock market news and how that affects the different stocks that they're investing in. So we're going to go through those, some of the changes in hedge fund and institutional investor ownership in different stocks, why they're moving the markets the way they are, and then we're going to get into some question and answer. So really excited about that, being able to connect with you guys there on the on a more face-to-face basis. So I see says sound looks good there. So let me know if if there's a lot of echo in the background or how it sounds to you. But again, we'll be hanging up some soundproofing and hopefully diminish that a little bit. Don't forget to join the community by subscribing so you don't miss a single episode. We do have tomorrow's video coming up, the 7 investing tools that I use every single week. A lot of you will recognize some of these tools and some of them not so much because I use them in the background for research. So some very good free investing tools that you'll want to check out. Don't miss that video tomorrow at 11:45 Eastern. Catch that one. I do want to, before we get started, I do want to highlight a free guide that I put together, a 5-minute stock analysis. This is a free quick win that I put together for all you out there in the community, and really just a way to get started with the kind of a stock analysis that I do for every stock that I look at. Again, it's as quick, easy 5 minutes. You're looking at different things like revenue growth, earnings growth, operating margin, just the core basic, the core things that you need to know to be able to make a decision on a stock. I put that together in a really quick 5-minute analysis guide. You can get it for free here with the link that I'll put in the description. That I put there in the chat. I'll put it in the comments as well. Again, no obligation. You just sign up there and you'll be able to download that absolutely free. But I want to get into today's topic though, because because I've got to get my son to coding class at 4:30, but 2, because there's a lot of information here and I really want to get to that question and answer session as well. So what we're looking at is those 13 Fs. So every institutional manager, every hedge fund, anyone with a large portion of the shares outstanding in a stock have to file a 13F with the Securities and Exchange Commission each quarter, reporting that ownership position. So at the end of the quarter, it's always a big deal, big stock market news of who bought what, who sold what, and how their positions changed. The hedge funds control over $1 trillion in assets. That's just the 878 hedge funds tracked by Bloomberg. So it is a market weight that doesn't even include a lot of the other activist investors, a lot of the individual investors, and things like that. So these are definitely something you want to watch for. There is a caveat to these, though, that they are all dated, right? They're all out of date by the time they get to investors' eyes and get to that reporting on the SEC, because since they are required to be filed after the quarter end for that quarter's trades. So, of course, the first quarter, for example, January, February, March, that quarter's 13F will be filed there in April or May, right? So anything you see in these 13F filings, it's all at least a month or two old as far as those trades. Now, what's the problem here is that a lot of these institutional investors, a lot of the hedge funds, they'll make those trades, first in the beginning of the quarter, and then by the end of the quarter, or even very early afterwards, they might sell out of those. I know a lot of hedge funds will just wait till the 13F comes out to highlight that bought position that they had, that stock position that they put on, see the stock go up, 2 or 3 extra percent, and then sell out at that point. And then, of course, you won't know it until the next quarter's 13F is filed, and you see that they turned around and sold that right away to book those profits. So you have to take this with a grain of salt. The big money players also aren't always the smart money. The smart money, I got to put that in quotes, in finger quotes because, it's historically they've been called the smart money because they have all that analysis, armies, teams of analysts behind them, analyzing stocks, things like that. Supposedly they're making good, smart decisions, but it's not necessarily the case all the time. So you really have to look at these 13 Fs for kind of a big picture idea first. Are a lot of hedge funds or a lot of institutional investors looking at one specific sector, one specific industry, adding on those? Are they early? Are they late? Is this information already outdated from when you get it? So you really have to look at them with a hesitant eye, but they can be very useful in spotting those trends in the market. Now, a few of these I want to point out here. Then we did see some major buying by hedge funds in a lot of those kind of AI stocks, and of course, this is obvious given the price reactions during the quarter. But institutional investors actually added 5.7 million shares of Meta, of the old Facebook. There, it was the biggest single purchase of stock in the second quarter. So out of all the hedge funds, out of all the institutional investors, they added almost 6 million shares of Meta during the quarter. That was more than any other stock. We also had big money positions added in Microsoft, Amazon, Apple, Nvidia, AMD. So again, following with that AI and big tech theme that we saw develop over that second quarter. These are all second quarter, so April, May, and June positions that a lot of these came in on. And again, this is all the AI, Microsoft, Amazon, Nvidia, especially on that AI positioning. We are starting to see some of that unwind. So what I'm thinking is a lot of the shorter term hedge funds, and the institutional, the activist investors might be selling out of some of theirs, or at least hedging some of their bets that they made there in that second quarter. One thing was really interesting was Intel, against all these other chip makers that got bought. Nvidia and AMD both saw big added positions, big net positions from hedge funds there in the second quarter. But Intel actually saw a net sell of 41 million shares. It was the one of the largest stocks sold among hedge funds managers in the last quarter, in the second quarter. And it's really on that fear that the chip maker is just being left behind, in this high performance chips race. Okay, so obviously Intel used to be the name in high performance semiconductor chips. They lost that. They fell behind. They started falling behind in that technology, and then being able to develop its successive chips. And they've fallen so far behind that obviously Nvidia is just eating their lunch. Even AMD and a lot of the other chip makers are really, lapping in Intel in its in its progress. And it's trying to come back. And, we've talked about this over the last couple of months. It's trying to come back, trying to get those successive chip designs out, and is just not doing well. One thing that really worries me about Intel, and I know a lot of investors out there, you're looking at Intel, you see, oh my God, this is so cheap on a price to sales basis. If we look at Intel, we can do a comparison here, and you can see why it would be so attractive. If you go to the statistics here on Yahoo Finance, you go to the basic, price to sales, basic valuation, 2.5 times price to sales. Now remember that. So shares of Intel, once great chip company, are selling for a price of 2.5 times their annual revenue. Now let's look at NVIDIA. Now, if we look at NVIDIA and we see what the valuation is on that, and it's almost going to be kind of comical. It was about 42 times price to sales. So that means, NVIDIA is selling for that price of 42 times 1 year's sales. Okay, so you look at that valuation gap between NVIDIA and Intel, and I know a lot of investors out there are thinking, man, that gap that, Intel just has to basically stay alive, and that should be a good relative investment versus NVIDIA, which needs to keep on dominating that chip race and growing those sales by 20, 30, 40% a year, or investors are going to get a little disappointed, a little frustrated, and are probably going to sell that off. What we've seen over the past couple of weeks with the sell-off in a lot of these AI stocks and stuff like that. But the problem is, Intel has got some very very bad or very big hurdles that it is trying to take all at once, right? It wouldn't be so bad if they were just trying to create successive high performance chips, or if they were trying to recapture some of that market share for high performance semiconductors, or if they were just trying to be a foundry, one or the other. But they're trying to do both of them. They're trying to jump both those hurdles at the same time. And let me tell you what they're actually trying to do. So if you don't know, most chip companies, NVIDIA, a lot of those semiconductor companies, they only design the chips. Okay, then they contract with someone else, usually Taiwan Semiconductor. They're the biggest chip foundry in the world and by far create most of the chips. But they contract with these chip foundries to manufacture those semiconductors, right? Well, Intel is now saying that it wants to be a foundry as well. So it wants to do both sides. It wants to create the chips, it wants to design the chips, and then it wants to manufacture them as well. Very difficult to do, all under one house, and I would say impossible to do for someone like Intel because, one, not only do they have to spend tremendous amounts of capital investment just to design those chips and catch up that huge gap that they've got, that knowledge gap that they have with NVIDIA, they're also having to build out that foundry service. So I just don't think it's going to happen. In fact, we did get a termination. We did hear about a termination of a $5.4 billion acquisition of Foundry Tower Semiconductor recently reported by the company, by Intel. CEO Gelsinger at one point said that was keystone, that acquisition of Tower Semiconductor was keystone to Intel's goals of becoming a foundry business as well. Of course, so that the idea of becoming a foundry business is that it could then bring in revenues from other chip makers that would then, pay it to manufacture their chips, and it could then in turn as well manufacture its own chips. So again, Intel seems very cheap at this point. It seems like it could be a very strong return if they can just keep the company alive. But I would say they're coming at it all wrong. Okay, they are trying to take both those hurdles all at once, and I don't think they're going to do either one of them well. So that's why we saw a lot of these institutional investors, a lot of the activist investors, and the hedge funds really just kind of jumping out of the stock during the quarter when everyone else was buying, or they were buying other semiconductor chips en masse. Another one that caught my eye here. Not necessarily hedge fund purchases, but some news out of Yardeni. Ed Yardeni runs a shop there, a research shop. Some very good analysis usually by Yardeni. And I only pointed out because he's talking about disinflation, right? And how inflation is actually lower than we expected. It is coming down fast enough that the Fed will be able to hold its rate cuts eventually, or hold its rate increases, eventually start cutting rates. And I pointed out because Ed Yardeni was actually one of the first to call this new bull market last year, even when other analysts, myself included, were really skeptical about this bull market. I thought we would see, a sell-off before now. I saw earnings decreasing. They have decreased for 3 straight quarters already. I saw that. I thought stocks would sell off a little bit more, and before just the last couple of weeks. But Ed Yardeni was actually calling for the bull market last year, and has done really well. I think he was calling November, December at that point. But now, so I'm putting a little bit more credence to his disinflationary environment and some of the research he's pointing out. You can always find a lot of his stuff there at yardeni.com. A lot of the charts, they don't give you a lot of content or explanation. They just kind of give you the charts and let you figure out for your own. So we can walk through some of these, but a lot of this talk about a disinflationary environment that he's talking about. And again, this is very important because it's going to determine what the Fed is able to do as far as interest rates. If the Fed has to continue to raise interest rates to fight inflation, because inflation remains stubbornly high, it is going to kill off stocks. Okay, we've already seen the 10-year Treasury at about 4.25, 4.3%, which is about a 15-year high. That is choking off the economy, that is choking off lending, and it's in turn choking off a lot of stocks over the last couple of weeks. So if the Fed is not able to hold its rate hikes and eventually cut rates, then because of inflation, it's going to be bad news for the stock market. But Yardeni here is saying we're in a disinflationary environment. Besides just the demographics, older population, people leaving the workforce, technological progress that is also bringing prices down, as well as just the mountain of debt that is owed by consumers, that is owned by governments, that acts as a kind of a natural way to bring down inflation because, we can't afford higher rates. that might not be so difficult for the Fed to get its inflation target back down. In fact, one of the biggest parts of inflation lately, consumer inflation, has been rents, right? Rents have been rising over the past year or better. But the CPI, the consumer price index that we saw just last week, or just a week before last, I believe on the 12th, was X rent, CPI X rent. So without the rent component of it was just 2%. Okay. And so we know that rent is very lagging. It's starting to come down, but it's still holding that CPI number up. So the CPI was somewhere around 4 or 5%, I believe. Still very much higher than the Fed's 2% target, where it wants to get inflation down before it can start, really thinking about cutting rates. But the CPI X rent without rent was down to that 2%. So as we see rent continue to come down, rent prices and that rent inflation continue to come down, that's going to act as a tailwind to bringing overall inflation down. So I thought that was some good research on your Denny's part there. I want to highlight a couple more of these, before we get to the question and answer. One here, I did want to highlight Michael Burry. He's, obviously the Big Short investor there, made the movie out of him, as well as the book by Michael Lewis. But Michael Burry is always famous for about 2 months or so when he gets a call right. Just recently, over the last couple of weeks, it's been reported that, the hedge fund Cyan Asset Management, which is his hedge fund, bought 200,000 put options against the SPY, that's the S&P 500 index, and then 200,000 puts against the QQQ, or the NASDAQ 100. And of course, so those put options give him the right to sell those indexes for a certain price. As those indexes come down, as we've seen over the past 2 or 3 weeks, down about 4%, he's made pretty good money on those. The problem is, a broken clock is right twice a day. And that is probably about the best analogy you can get for Michael Burry. And I'm going to explain why. I know a lot of people really love following him. They think he's just the greatest investor since Warren Buffett, given the movie and all, but I'm going to explain here. The SPY again. Understand that these put options were put on, over the last 3 months or so. These are the quarterly reports. The SPY, so that S&P index, was up at started the quarter at 409. It's rose to about 443 during the second quarter. It's now about 440. So it's likely he's still very much underwater with these. And the problem with Michael Burry and many of these hedge funds that we follow is if you follow them as almost a cult and almost a cult following, right? You just take their word as gospel. Then they're negative so many times, especially a lot of them. Rubini, Nouriel Rubini, Dr. Doom is what they call him, because he is so pessimistic all the time. He's a perma bear. Michael Burry here, he is a perma bear, and he's wrong so many times. And the problem with this is, folks, being early to a call is just as bad as being wrong. Okay, you can, like we saw here, just using this as an example, if he bought those put options against the SPY and against the QQQ early on in the quarter, he could still be underwater by 20 or 30 points on those. He is called bulls, or he is called bubbles in the passive indexes in 2019, 2021. He said there was going to be the mother of all crashes because of passive income indexing. He called June 2021 was when he said there was going to be that mother of all crashes. He missed a 12% upside gain from that point to the top in January 2022. Just this other one, just more recently. Here he's, just this last, I guess it was last August, he said he sold everything, sold 95% of his portfolio, which is, even if you're a very good investor, better than Michael Burry, maybe Warren Buffett, you do not sell 90 or 95% of your portfolio unless you do have some kind of a crystal ball, because nobody is right 100%, nobody is right even 70% of the time, 80% of the time. You try to be right 60 or 65% of the time. You try to hedge your bets to the downside, and you try to make that alpha, that alpha premium on your investments. And so to sell 95% of his stocks, he sold everything except one stock, the Geo Group. since that period, since that time in August 2022, so last year. The S&P is up 12%, so he missed out on that. And then that Geo Group is down 15%. So, it's not that he's, he is a smart investor. He's got a team of analysts there working with him. And I respect a lot of the calls he's made, but he just tends to be so histrionic on his calls, selling 95% of the time. And I think it's dangerous for activist investors or institutional investors they can do that if they want, but then to go out in the press and say, hey, I sold 95% of my stocks. The mother of all crashes is coming, especially for someone who's been highlighted in a book, in a movie. Investors are going to follow him into that trade. They're going to lose a lot of money. And, and I think that's just dangerous. So I'm going to get off my soapbox there and turn it over into the Q&A section, because this is the part where I look forward to for these question and answers, or for these live streams, just kind of reaching out to you. See if you have any go scrolling up the chat there, see if you have any questions. If I don't see your question, please make sure you ask it with a question mark so I can see it. Went out. Okay, so Alan says, went out and back into MPW. So I want to address that. I want to address Medical Properties Trust, because I know there's going to be a lot of questions on it. It's fallen quite a bit, fallen from, I think it broke $10.20 a share just the last couple of weeks. On its earnings, it has fallen back quite a bit, given up a lot of that. It's given up probably about 25-30% just in the last couple of weeks. We can show that here on Yahoo Finance to show you just how bad it has been and what we're doing about it. MPW. There we go. So we do see it was up 2% today, but still at $7.53. Here we see the, so it fell quite a bit there at the beginning of the year, but then it did make it back to about $10.60 a share, and has since fallen to $7.53. Now, a couple of things happened here. I'm going to tell you why I'm still in the stock, what I'm waiting for here. Just this last earnings were reported, and while it is making progress to kind of clear up some of the problems with those two biggest tenants, really the biggest problem with MPW is a lot of its business comes from just two tenants. Okay, it owns healthcare facilities, it owns the hospitals, it owns the clinics, things like that, and then it leases those properties back to the healthcare servicers. Two of its tenants, very large medical services companies, Tenet Healthcare and then Prospect Medical, are falling behind. They're in financial troubles. We've seen that a lot of not just those two companies, but across the healthcare sector over the last couple of years. Reimbursement rates have not kept up with inflation, and obviously a lot of those non-critical, higher margin surgeries and elective procedures were pushed off during the pandemic. So a lot of these healthcare services, a lot of the hospitals really came into financial troubles over the last couple of years. Tenet and then Prospect Medical are two of the hardest hit, and they are a big chunk of the revenues for MPW. Now, we've been hoping that MPW is kind of guiding away from this. We did see that, I think it was Tenet that sold a lot of their Utah properties, or sold a batch of their Utah properties there a couple of months ago, and then used that money to pay back a loan that it owed MPW. We've seen some other progress in some of the other issues. The problem with this quarter was, one, MPW seems to be kind of doubling down on these two servicers. And, obviously I don't have any inside information, but it appears they're really kind of trying to keep those two tenants afloat. It is investing equity into the companies. It is extending their loan terms, which, a lot of banks, a lot of real estate owners are extending loan terms out to their tenants. Just because, and to the owners, things like that, just because real estate has fallen so hard over the last year because of those rising rates. So it's not necessarily doing anything that a lot of banks and a lot of other companies are doing. We had just hoped that it would be pulling back a little bit the responsibility to these two tenants, and kind of mitigating those two customers. But it does seem to be going a little bit closer into those relationships. Another thing that really hit, the biggest thing probably that hit the shares there in this second quarter report was an analyst asked about the funds from operations, specifically about the adjusted funds from operations, and if that was going to be able to cover the dividend of $1.16 a share per year. Right now, it's about 15% dividend yield, which is an amazing yield. But there are some questions of whether they will make enough cash flow to cover that dividend. In the past, the management has said that they will make about $1.60 in funds from operations this year, very much covering that dividend. That adjusted funds from operations, though, where they remove some of these other cash flow items, that might come under a little bit under. So management did say during the call that everything was on the table. They didn't say dividend cut. They didn't say the word dividend cut because that would be pure murder for a stock. But the analyst was kind of pushing them towards that direction. And all management would say was that everything was on the table. Now, what does that mean? I think they can cover their dividend with the fat cash flow, with their funds from operations, and even with their adjusted funds from operations. The problem is I think management may decide to be a little bit more conservative and protect cash. Okay, they are in crisis mode right now. They want to just get over this hump where we have the high point of interest rates. As interest rates start coming down, all real estate is going to be boosted when that happens, especially these healthcare REITs that have been hit so hard. Once we are starting to see healthcare facilities and servicers come up on their operations, so that will help the cash flows for the stock as well. They're just trying to get over that hump. Okay, so a lot of times when you see a dividend cut, it's because management is just being overly conservative, trying to conserve and protect cash so they can obviously stay in business and get over that challenging period. That could be what happens here. And I am, while I say that, I am still holding my shares. I still have, I have about, it's either 18 or 21,000 shares of MPW. It's a cost basis of about $10.20 is my cost basis. So I am lower here, but I have collected that dividend for about 2 or 3 years there. So I am in the shares at that cost basis. I have picked up the shares. I have dollar cost average as the shares came down to lower that cost basis. I'm holding right now, though, because I do want to wait until if we do get a dividend cut announcement. I believe a dividend cut announcement, it could bring the shares down even a little bit lower. One thing I'm thinking here, though, especially for new investors, but even for investors that have been holding on and have that opportunity to pick up a little bit more shares, if that price comes down, if we do get a dividend cut, pick the shares up at that point at that lower price, your dollar cost average, you're down. And then even if this is cut, even if we say it's cut, almost in half, let's say 80 cents, if it's cut by 80 cents, or cut to 80 cents dividend per year, that is still a solid more than 10% yield. Okay, that is a 10% yielding stock, very strong upside potential on the price as we get over these hurdles with real estate and with healthcare real estate in the next couple of years. I think that's the point where you really back up the truck and start buying. But I am holding at this point, waiting for that time to see that opportunity. I want to look at see what else we got for questions here. Excuse me. Okay, Jack wants to know about TSLY. Not going to cover that just right now. I did do a video on TSLY and some of these stocks, those very, very high yield stocks, 20-30% yielding stocks in the past couple of months. So that's why I'm not gonna do too much of it right now, but I'll show you how to find those. If you go to videos on the channel, you go to this little hourglass here and you go to, let's just try TSLY, and that should bring it up here. No, I think the other one is NVDA, is one of those big ones, NVDA. Okay, here it is. If you go to get a 38% dividend on NVIDIA and other AI stocks, that is the video That is the video where I talk about those that TSLY, that NVDA, the stocks, the funds, the one stock funds that are providing that 38% dividend. So much more detail than I can go in right here on the live stream. Again, just what I said in that video, there's no way they are going to be able to cover those dividends into the future. They are very much a volatile, dividend up or down in any given month, just because of what they're doing. They're selling covered calls on those, so they are going to follow those stocks lower when they go lower over the last, like they have over the last couple of weeks. And they're going to collect less in dividends for that, or less in call premiums to be able to pay out as those dividends. So watch that video. Again, it's the title, Get a 38% Dividend on NVIDIA and Other AI Stocks. I go more in depth into what they're actually doing here with that TSLA and with the NVIDIA, ETF there. What else we have? Hey, Lifters Gym, see you there in the chat. Good to see you there. Chad over there at Albemarle, over at Lifters Gym there in Albemarle, North Carolina. NS wants to know thoughts on BITO. Okay, so we got BITO, which is the Bitcoin ETF. We also have the several other Bitcoin ETFs and Bitcoin funds out there. I own shares of BITO as well as the other fund, the older fund. We'll just bring this up on the screen here, and these have all sold off just recently as the price of Bitcoin came down. I did see today that Bitcoin came down to something like a 3-month low. It was Bitcoin was down to something like 27,000, 28,000. We see the GBTC, the older Bitcoin fund here, was also down about 5% today. The BITO is down as well. Now, I've owned GBTC for quite a while, really on the, not just the long-term upside view of Bitcoin, but also on the gap in the assets versus where that was trading. That gap is really narrowed now, so there isn't quite the benefit of holding the GBTC if you're taking that long-term Bitcoin view. I do prefer the BITO here, the ProShares Bitcoin Strategy ETF. It's basically the same thing. It's going to hold those Bitcoin futures and give you exposure to the Bitcoin theme. But what I like about the BITO is you can sell options against it, right? So what I do, I buy, I'll do something like I'll buy the options, or buy the stock here. You got 1440 there, and if you go to options here, now of course this is going to limit your upside on those if Bitcoin takes off and these shares really take off. But if you go here to, we'll go to January, so about 6 months out, about 5-6 months out, and you go here to, even the We'll sell the 17s. So if it's trading right now, 1440, right? It is 1442, okay? And then minus, if we sell something like the covered calls, sell the covered calls for 60 cents each. You just lowered your cost basis to $13.80. So 14.4. You got a 4%, 4% cash yield on those shares for 6 months, and the upside is still, so $17. That call that you sell someone else for a strike of $17 is still 23% higher from what your cost basis is. So you can lock in a 4% yield, lower your risk, lower your cost basis in those, still have a 23% upside potential on that. So that's something I've done in these in these Bitcoin funds, just because they are so volatile. You get a really good premium on those, and it's worked out in the past. Now, it did kind of take away from some of my returns if I, just this last couple of months when Bitcoin was up to, 30, 31,000, 32,000. So you do limit your returns on that if Bitcoin really takes off. If the SEC finally gets off its ass and approves a Bitcoin ETF, then, a spot ETF, then Bitcoin will take off. and you won't want to have those covered calls sold against your position. You'll just want a flat position in the BITO, in the GBTC, in something like that, and just ride those higher. I'm saying, there was no way in hell the SEC chair was gonna approve any ETFs while he had any kind of control or power there. He's starting to kind of be pushed and pressured by everyone to approve those. But for the longest time, these just weren't going to be converted, and you can make a lot of money selling these calls against those for those very high premiums. But if you're just looking at Bitcoin, I mean, I do own Bitcoin, I do own Ethereum, I own those ETFs that cover them as well. I think some of the things we've said in the past about those cryptocurrencies and the technology behind it, the blockchain behind it, I think it's still a very good investment in the future. You just have to have patience to let it come out. Okay, what else? So Alan has put it together. Michael Hogue, you two related. Yep, Michael's my son. He's just kind of stalking. He's trolling my live stream, dude. Okay, so he's downstairs on his computer, I guess. But what else we got here? Thanks for hosting these chats. Very informative. Look for some good news on REITs if possible. So Mark, yeah, he's waiting for good news on REITs, on that REIT specifically for MPW. I would say there is, we've talked about the real estate and real estate investment trusts over the past month or so. I think good news is coming for those. Again, what you can look forward to with these real estate investment trusts is that, they fell something like 25-27%, hardest hit sector in the S&P 500 last year, just because of that rise in interest rates. Obviously, real estate is very much over leveraged, so anytime interest rates go up, that's the cost of borrowing, as well as very much cash flow problems for these real estate owners and these operators. So we saw a big hit to real estate. We're seeing, I think it's up only maybe about 4% this year. And we can actually check on the on the sector tracker to see how that is performing so far this year. So we'll go here year to date, and we do see now real estate is down again this year, 1.5% down this year. Also, I'm not saying there isn't more pain to come, especially in the office space, in some of these other hotel and leisure spaces, things like that, as consumer spending takes a hit in the economic slowdown. But if you look at real estate and how it's done over the past 15 years, in 2008, when it had that down like 47%, it was then the top performing asset, the top performing sector in like 5 of the next 6 years. So I think that's what we're going to be looking at here over the next few years for real estate as well. I think these are good times to start selectively picking up some of these REIT stocks. And you're going to do very well over the next few years, especially as those interest rates start coming down once again, as the Fed starts bringing down its interest rates. And again, we're seeing evidence that they're going to be able to do that in that disinflationary environment that Ed Yardeni was talking about, as rent prices start coming down and provide that tailwind for inflation to come down. Then I think the Fed can start, stop talking about raising rates. They'll be able to do that. And then eventually they'll start talking about cutting rates to support the economy as well. And that's really when you're going to see real estate and real estate stocks take off right there. Okay. Okay, IMJ says, holding many pandemic-era dividend stocks that are still in a profit. Do I take profits or reinvest in the sell-off or hold my permanent profit levels? It's really when you need the money. Okay. I feel like investors everyone's a short-term trader anymore, right? Back in the 50s and the 60s, the average holding period for investors was something like 8 to 12 years. If you look at New York Stock Exchange data now, average holding period is less than 6 months. So less than half a year. Most people hold their stocks. Always looking for, the perfect time to take profits and wait for something. And I think, you really don't need to trade that often unless you enjoy it, unless you have some kind of inside scoop on it. Then I would just hold those. If you don't need that money for the next 5, 10, 20 years, then I think I would just let them ride, especially if you really like those companies, if they're good dividend growth companies. That are growing their dividend every year. It's a good payout, and it's companies that you like and companies you can count on. I say you hold them. What else? Is Apple at 175, Google at 130, AMD at 105? I don't understand the question there. If you got a question on those, let me know. Do you think NVIDIA is overpriced stock? So Classified wants to know if NVIDIA is an overpriced stock. Short answer, yes. Long answer, hell yes. I mean, one thing you got to understand about me, folks, is I am a little girl when it comes to paying too much for a stock. Okay, I run and hide. Maybe that's sexist. Sorry, I probably shouldn't say that, but I got weak knees for paying too much for a stock, because it's just bit me in the ass too many times. Straight out of the Marine Corps, 2002, 2003, everything was going up. I was playing momentum trading. I was paying any amount for any stock. It didn't matter what the valuations were for it. I was just riding those stocks higher, and I was doing pretty well. And then I remember, I think it was 2005, Mother's Day. I had gone down to Biloxi to visit my mom. She had moved down there to help with the Katrina cleanup efforts, and I was visiting her over the long weekend around Mother's Day, and lost something like $18,000 just over the weekend, or over the Friday and Monday. Kind of ruined my weekend there because I was chasing these high valuation stocks, momentum trading, all that kind of stuff, and the market and those stocks just sold off. So it's kind of turned me into a value investor. So understand, when I say NVIDIA is expensive, I've also missed out on things like Tesla, things like Amazon in the past. These stocks that are just so terrifically overvalued perennially. Amazon, just until the last couple of years, was always trading at above 10 times price to sales. Okay, Tesla still trading. Well, I think it's down into under 10, but almost always 10 times price to sales. A lot of these cloud security, these internet security stocks trading well over 10 times price to sales ratios, and I just won't touch them. Right, so I have missed out on some of those big growth stories over the past years, but I've also protected myself. I've also not fallen for a lot of those pandemic stocks that were 20, 30, 40 times price to sales before the sell-off there in 2020, 2022, and have since lost 70, 80% of their value. So if you stick to that guideline of 10 times price to sales, it's going to be hard, because a lot of your buddies are going to be saying, man, I'm making a killing on NVIDIA. Went up 2 times, threefold this year over the past 5 or 6 months. But then they're not going to tell you when they lose, 60, 70% of their money, because they had it in some stock that was so terrifically expensive. So you really have to have the confidence in that long-term idea of investing. Now, I will say NVIDIA. I mean, if there's any stock that I would just pay the price, it would be NVIDIA. They are dominating in chips. Just like Taiwan Semiconductor is the dominant foundry business in chips, NVIDIA is really the dominant chip maker, or the chip designer, right? So all those AI chips, semiconductor chips that we're going to need over the next 5 or 10 years, NVIDIA is the company to beat as far as the designs and the performance chips. That's going to go into there. And of course, that's what's priced into the stock right now, trading at 42 times price to sales. Versus other chip makers, like we saw Intel trading at 2.5 times. I think even AMD. What's AMD? I think AMD is like is 13 times, if I remember right. So Advanced Micro Devices, and they make some good chips. AMD makes some high performing chips, and they are priced at. Let me share the screen so you can actually see this. But so AMD priced at 8 times price to sales. So if you compare that to NVIDIA. And we can look at relative growth measures for these, and this is all the kind of things that you need to do, folks, when you're analyzing and deciding whether to buy a stock. What's its valuation? Is that valuation merited as far as growth statistics? Okay, so here we see analyst estimates for AMD expected to pretty much flatline on revenue this year, down 3.3%, but it is expected to rebound 20% sales growth next year. Well, we see, earnings expected up $4 versus $2.76 for earnings per share this year. Okay, So fairly good growth this year. They did, they stumbled obviously this year. Now, if we compare that to Nvidia, so remember we had about a 8 times price to sales for AMD. That's the price that investors are being required to pay for shares of AMD, 8 times, and about 20% sales growth expected next year. Now we have Nvidia here trading at 42 times price to sales. They grew sales by 63% this year, expected to grow by 35% next year. So again, taking that into account, taking the operating margins, so that was profitability, taking all the other things that you look at as a fundamental analyst, and you have to ask yourself, okay, yes, Nvidia is way out ahead of all these other chip makers. Okay, that's a given. Is it far enough out ahead, and can it maintain that to justify this huge price gap valuation? Okay, trading for 42 times on a price to sales basis versus 8 times for AMD. So Nvidia just has to keep up that pace. Nvidia has to keep up, 25 or 35, 40% year over year sales growth and the earnings growth to boot to be able to justify that price. Otherwise, investors are going to get spooked and head for the exits and sell the stock. So that's something you gotta think about. For my part, again, I cannot pay 40 times price to sales for a stock. I'll wait till it comes down. It does come down. If you just look here at AMD or Nvidia, if you look here, you look at this price to sales history, and just over the last year, it was down as low as 11.5 times just last October. So I do think you get a better chance, a better opportunity to pick up those shares at a better valuation. I would start playing, I would probably, again, I hate to break my rule of 10 times price to sales. I don't think it's ever going to be under 10 times price to sales for quite a few years for Nvidia. I would consider it maybe at a 30 times price to sales, maybe 30, probably not 35, but definitely 30 times price to sales. I would consider shares of Nvidia. But again, I'm the cheap ass value investor that does not want to pay too much for a stock. I'm willing to miss out on some of those huge stories if I can also miss out on some of the big crashes. So just food for thought when you're looking at some of those high growth names and things like that. What else? Microsoft. Is Microsoft a buy? Microsoft, I think, is kind of the same story there. Microsoft is doing very well. Obviously, Microsoft was one of the first investors in OpenAI, which is the company that owns ChatGPT, and so is going to do very well in its in its AI endeavors. In fact, it's already applied ChatGPT and that OpenAI technology to its search engine. I think it's probably taking some of that search engine leadership away from Google. So it's doing very well. But again, you look at the valuation here for Microsoft and trading at 11.3 times price to sales. Not too bad, not overly, not ridiculous like we saw with Nvidia. But this is a very large company, and it isn't going to be turned solely on the basis of AI, right? We're here with the analyst expectations. We see only 11% sales growth expected this year, 13% next year. So it's not runaway sales growth either. Earnings doing very well, and it's a very good company. I use Microsoft products myself, and I like the company. I think it's just a little bit overvalued at this point. If we do go back to those statistics and the valuation, you can see, okay, so 11.3, it's traded down as low as 8.9. 8.8 there last September. So I wouldn't expect it to get down to that point, down to under 9 times price to sales. But I would like to see it get down, maybe a little bit lower, maybe down to 10 times price to sales. I probably wouldn't break my rule of 10 times price to sales for Microsoft at this point. And one thing you got to understand about that investment in OpenAI, it is still, OpenAI was structured really differently. It's structured as a nonprofit organization and open to everyone, nonprofit, and then just like a portion of it was broken or was structured as for investment. But the way it's really weirdly worded in the documents, where it can't make like unlimited profits, right? Those profits are capped, and the rest has to go back to that nonprofit charitable organization kind of idea. So that's going to limit any kind of returns that Microsoft can see from that investment. Okay. Rakesh wants to know about Icon Enterprises, ticker IEP. I've really liked Icon Enterprises in the past. It has had some big problems here lately, starting with that short seller. There we go. IEP. Starting with that short seller report here over the last couple of months, it's fallen like a rock. Here you can see here in April, May, it was right around 52. It's traded basically about half that. They actually did end up cutting the dividend just recently here. We can see the dividend price history here, and you can see dividends. So it was paying out a $2 dividend. I believe he's cut that mostly. I can't remember what he cut it to, but he was forced to cut that dividend to protect cash. Again, I think a lot of this was management just being conservative. So they did cut it in half. They cut that dividend to $1 per share. That is still a pretty solid 5% dividend yield. And I think, again, it is conservative to protect cash. And I think, one of the things I really like about this Icon Enterprise, the stock, that ticker IAP, is that you are able to invest alongside or piggyback basically on an activist investor like Carl Icahn. Now, granted, the guy's in his late 70s. I think he's like 76. He should be retired and fishing. He's being forced to kind of protect his legacy here. So I think he's going to work his ass off to get this stock back in the black and to make good returns for his investors. But I would be picking up shares here. In fact, I might add to my position here to dollar cost average down, because I do like that idea of being able to invest with the activist investor. Most investors aren't able to do that because they're not accredited investors, so they can't get into a lot of those hedge funds and those private equity funds that are available with these. So this is just one way to do that anyway. Okay. What else? Okay, so Max, $5 super chat. I appreciate that. Thank you. Says thoughts on buying FRBK. So FRBK, this was a stock we were in. We were in earlier, right? Republic First Bancorp. No, this isn't. Is it? No, this is the defunct bank, right? Yeah. Okay, this is year to date. Oh, they've fallen. Okay, so they're in non-compliance with the with Nasdaq in jeopardy of being delisted. I'm trying to think. Okay, First Republic, FRCB is the other one. First Republic and Republic First. Okay, Republic First was the one we were in. We had it all the way down to about 70, and then it went up to $100.80. I actually sold out about $1.26. It was right here in the $1.20s, and it's looked like it's fallen further in that. I would say if it's fallen this much further in that period of time, there are structural problems with this bank. You look at it is in non-compliance. Got a non-compliance notice from Nasdaq. It could be delisted, so I probably wouldn't touch it at this point. At the point that we were investing in earlier this year, after the banking crisis, obviously it had got caught up in just the name, right? Because that First Republic that went defunct, that got taken over by the FDIC, First Republic, FRCB, shares a common name, so a lot of people were selling out of this stock just as a name mix-up, right? It was still a very good investment. Got it down to about 70 cents a share. I think my cost basis was right around somewhere in the 80s, 80 cents, 85 cents a share for this. And then we sold it there at $1.20, $1.25. But after that, if it can't, a lot of the other banks, they have moved well on from that banking crisis pressure and the problems. If it can't do the same, if it is continuously making new lows, then there is structural problems with that bank, and I would just move on, look for something else there. What else? Intel price. Okay, Jackie Z, $2 super chat. I appreciate it. Thank you there. Thoughts on PayPal? It falls so much. PayPal is along with Teladoc. PayPal is probably two of my most disappointing stocks. Right, these stocks do have some very strong advantages over their competition. They both dominate their field, right? Teladoc in virtual healthcare, PayPal in payment systems and digital wallets. They should be doing very well. I still think they have very strong futures, but I think it's a management issue. I think management is just not able to turn these companies into what they can. That said, I am sticking with them because I just think they have such strong potential in both of these companies, okay, Teladoc and PayPal, that I think eventually that will be proven. We did see for PayPal specifically that Elliott Management, activist investors, sold off their shares. I think they probably, they wanted a different direction with PayPal than getting that new CEO that they announced just recently. So I think Elliott maybe wanted strategic options, maybe to sell the company or something like that. And the company obviously, went in a different direction. So Elliott Management did sell off their position. PayPal has been really weak lately, and especially after it did well on the earnings. The earnings were good. Revenue growth was good. I think it was 13% year-over-year revenue growth. So it is performing, and it is a very good value right now. We can go to PayPal and see that value in the stock, but I'm holding on to the shares just because I think eventually that growth thesis will play out. Okay, so if we see here to statistics, well, let's look at analysis first. As far as growth there, so we do see 8% expected sales growth this year, 9% next year. Not bad. It's obviously not the growth stock that you would hope it was. $5 per share. So it's trading right around $12 on a PE basis, which is very low for a growth stock, or for what should be a growth stock. I wouldn't call 8 or 9% annual sales growth yet. But 2.3 times price to sales. Here, trailing PE 16.7 times. It's right around 12 times PE for forward earnings. So it's not necessarily the growth stock that we would like it, but I think that growth does come out. I think once they monetize those digital wallets and those assets, they are starting to make progress in its own stablecoin and how that's going to be integrated into the larger payment structure. So I think they are returning to some level of growth, and it's just a matter of time before they unlock that. So yes, I am sticking with my PayPal position. I'm sticking with my Teladoc position. Again, very disappointing and frustrating that those stocks can't do something like what we've seen SoFi do. SoFi has at one point more than doubled its price this year, and really starting to prove that growth that we've been looking for. So what else? So how much of your portfolio is in dividends versus growth? I'm 47 years old, so I still got a long time to invest. I will hopefully never stop working. So actually, most of my portfolio is in growth. I don't like paying the yearly taxes on those dividends. So almost all of my dividend stocks are in my retirement accounts, right? And of course, you're limited to how much you can put in those retirement accounts. So I'm limited to how much I can invest in the dividend stocks. All right, so most of my dividends are in retirement accounts, so you're not paying those taxes every year. That's really the killer for dividend stocks, is you're paying taxes on those, especially those some of those non-qualified dividend stocks like the monthly covered call ETFs, things like that you're paying income taxes on if you hold those in a regular taxable account. So most of my dividend stocks in those retirement accounts, and a relatively small portion of my portfolio. Obviously, I still love those dividend stocks, especially the ones like MPW that we talked about, and I still hold a lot of those. But it's mostly growth stocks. I really like to look for that industry and that technology that is changing the way we live, finding the dominant player in that, and then invest in that as that growth theme. Okay, we are heading towards an hour, so I got to get to my kid to coding school. Like I said earlier, if I didn't get to your question, please ask it in the comment section below. We're going to try doing these again every Tuesdays and Thursdays at 3 p.m. Give you a market update and some stock market news to follow there. Don't forget to get your free 5-minute stock analysis guide there. Got that link in the chat. I'll put it in the comments below as well. Absolutely free. Just a quick win for you. Figure out how to analyze stocks in as little as 5 minutes. Click on the video I'm going to leave here for the Warren Buffett 5 ETFs that Warren Buffett would buy. He's going very hard into one particular geographic region, into Japan, just over the last 3 or 4 months. I think it's a really interesting play. Don't forget to join the community by tapping that subscribe button and clicking the bell notification.